Hi there, my name is Vinnie Rasile. I'm an instructor and professor for Accounting 1040. This is a tutorial on 12-5. We're going to first get started by reviewing the problem, and then we're going to get straight into the solution here. So let's just hide this so we can first focus on the problem. So I'm just going to read the problem out loud so that you have a good grasp on what the problem is and how we can move forward with resolving it or solving itself step by step. So let's take a look. On January 1st, 2019, Chris Hunt and Carol Lowe form the Chris and Carol partnership by investing the following assets and liabilities in this business. They provide you a list at book value of each person's assets and liabilities, consisting of cash, equipment, accumulated amortization, etc., etc. Then they have a series of facts that they get into. An independent appraiser was hired to provide current market values of all of the assets. They are valued at these series of numbers for Chris and Carol both. Chris and Carol agree to share the profits and losses in the ratio of 60-40, 60-40 meaning 60% to Chris, 40% to Carol. During the first year of operation, the business's net income, is $74,000. Each partner is withdrawing $30,000 in cash. The requirement for this problem is to prepare journal entries to record the initial investments and to prepare a balance sheet after the completion of the initial journal entries. Take note of the balance sheet date. It's January 1st, 2019. When does this start? January 1st, 2019. That is your date of the balance sheet. So just make a note that you know that understand the dates here. So with that, we're going to get started on reviewing the facts in the problem and then reviewing what each of the steps are moving forward. I'm going to just first start by hiding all these items so that we don't get distracted with other facts here. So let's take a look at the first initial facts. One of the things I like to do when I'm looking at a problem like this is it's got a lot of verbiage in it. It's got sort of longer pieces of information, and rather than having to go back and forth and keep rereading the problem, I usually just lay out the facts and jot them down first thing right at the top, either on scrap paper if you were in a testing scenario, or in this case in Excel. So we see here we've got some assets and liabilities based upon the information provided, and I've just listed out Chris's equipment, Carol's equipment, Chris's building, Carol's building, land, profit share of 60-40, net income of $74,000 at the end of year one, and then the partners withdrew $30,000 each through the year. So these are initial transactions or initial occurrences. This is sort of at the end of the year in terms of the net income and the partner draw. So let's take a look. The first requirement was to record the assets and liabilities of each partner at the beginning, based upon the initial investments. So what did we do for initial investments? Let's take a look here. I'm just going to try and hide these slowly so that we can kind of take a look. So the first thing we want to do is we want to take each person's market value of their assets and then their liabilities and record those. So in this case, we have cash of $12,000 based upon what Chris is listed here as $12,000 cash. We have equipment of $29,000. Take a note here. What I've done is I've taken the appraiser, the market value at the time of investment at $29,000. This is a new business they're investing in, and so the asset is to be recorded based upon the current appraised value. So we've taken the $29,000 from the fact straight there. The building, same thing for the building. Land has no depreciation or amortization, so the land is recorded based upon what's been provided here. So those are the assets we're recording as a debit on the balance sheet because this is where the assets are located. Let's take a look at the next two, which are the liabilities. So we have an accounts payable according to this chart here of $35,000, and we have a notes payable of $17,000. Both of these items are going to be recorded as a credit. Why? Because they're liabilities. Let's make sure that we format it appropriately. I've indented it here to basically take a note that these are credits. So that's Chris's essentially assets and liability contribution. Next, let's take a look at the next few. So we have the same thing for Carol. We have cash, equipment, building, and then we actually have land as well. So let's just uncover all of those. Got a little typo there, so we'll just fix that up. So we have $18,000 and $18,500. Where is that from? That's from this chart here. Cash is cash. There's no amortization or anything strange happening. You record the cash as they've contributed the cash. The building is $110,000 based upon the current appraised value. So we've listed it at $110,000. The $80,000, the land has no amortization, so it's recorded as is. These appraised values are what matters at the point of the partnership formation. So again, they're going to have a couple of entries on the liability side, and so we're going to record those as well. So that's the $35,000 and the $28,000. Where are those from? 35 and 28 right here in this chart. So now we basically have the recorded entries that basically represent each person's contribution to the business, the assets they're contributing and whatever liabilities they're bringing into the business. These liabilities might be associated with these particular assets, which is why they're bringing all of them into the fold here. The next step that we looked at is to basically look at the balance sheet. So they want us to prepare a balance sheet after the completion of the initial journal entries. That is the important piece to note here. They do not want you to complete the balance sheet at the end of the first year of operations, where it talks about that in the last paragraph or section. They just said at the beginning, at January 1st, after the completion of the initial journal entries. So this is before any other business is transacted, and so that's why you want to basically unfold this piece of it here. So let's take a look at the assets. We're going to move these over. They are hidden somewhere in here, I hope. No, they're not. Well, let's record the assets then. Since we don't have them listed in here, we're going to record the assets as we have them. So the first, let's make sure we have all the assets listed first. So cash, equipment, building, and land are all the assets noted. How do we know that? We have these debit balances over here. So let's start with cash and make sure we record that here. So how are we going to add that up? We're going to add the $29,000 with the $18,500, which is $47,500. I think we have a number that's off here. So let's make sure we make a correction. This is cash. So we're going to roll this up, and this is equipment. Equipment is supposed to be under Carol, 47.5. Whoops. Let's make that correction there. So let's make sure we have the equipment corrected here, plus equipment here. And then we have building of 90 and 110. And then last but not least, we have the land that we are going to account for here. So as you can see, all I've done here is add these up to make sure that we have the correct amounts here. I think this one is a little off, 12,000 plus the 18.5. That's better. That's what we were looking for. So let's just recap what we've done here. All we've done is combined the debits and the credits under each account. So it's as if we would have a T account and we're basically just adding them up to list them on the balance sheet. As an example, let's just take a look here at what cash would look like as a T account. If we had a T account, we would basically have this line here. We would have, I'm just going to drop in a line here so we can take a look. We would have this line here as a T account. And so we would have a balance of $12,000 that's been entered in, oops, wrong side. We want it on this side over here on the debit side. And then we would have had another balance of another debit balance added in when the 18.5 was deposited. So the total balance on this account would be the 30,500. So all we're doing is using, instead of dropping in T counts and then transferring them to the balance sheet, we're just adding them up straight here to make it a little simpler. So I'm just going to insert some columns so you have some space there. So same thing for the liabilities. We have assets, we have liabilities. We're now going to go over and add up the credit balances on the liabilities as well. So for accounts payable, we have 35,000. Let's go back and correct that. We have 35,000 plus we have the 35,000. Pretty straightforward. We have notes payable of 17,000 plus the 28,000. So that totals 45,000. So let's just total these up. So just do a little quick sum here. And then we've got total assets of 465,000. Let's take a look and do the same thing for total liabilities. We'll actually make it appear in just a minute here. There we go. That's what we were looking for. And we've got total liabilities here of $115,000. Now, last but not least, we have the equity section of the balance sheet. This is the partner's equity that we've talked about in various classes and then in the slides. So let's focus on this piece here. And move back over so we're stopped moving around there. So we have the partner's equity section. If this was a sole proprietorship, it would just be basically, let's say if it was Chris's own business, it would be Chris's equity or shareholder equity. If this is a corporation, it would be listed as basically total shareholders equity. In this case, it's partner's equity. And so how are we evaluating the equity here? We are evaluating it based upon the assets less the liabilities of what each person has contributed or each partner has contributed. So in Chris Hunt's case, we're going to take the assets and we're going to subtract the liabilities, and we're coming up with 157. So what did I do? I added the assets, as you see in the formulation bar here, and I subtracted the liabilities. I'm going to do the same thing for Carol Lowe in this case. We're going to add them together. Apparently my battery is running low, so I better move this along. And I'm doing them super slow so you can essentially see step by step what I've done here. Okay, so again, repeat of the formulation bar, you can see how that's going, and then we're going to sum those together. Very straightforward, nothing hidden, no tricks around it. Okay, so you've got total partner equity of 350. Now we've got 465 over in the asset section. So what's the last thing we're doing with a balance sheet? We're not leaving this thing unbalanced. We have to add in total liabilities, if I can spell properly, and equity. And so what are we doing? We're adding the two of them up like you do in any other balance sheet. Nothing hidden, again, no tricks. Okay, so we've got total liabilities and equity. Let's just format this up a little bit. Okay, and what's the key thing we notice here? We're balancing 465 to 465. Again, nothing hidden, no tricks to it. So that's essentially it. That's basically the second part of the problem. Key things we focused on here that were really important is recording the assets and the liabilities that each partner has contributed, utilizing the numbers and the figures that were provided under the appraised value, because that is the current value of that asset, which demonstrates or provides the formulation for how much capital or equity each partner is actually going to secure or obtain within this business. The second thing to look at is the dates. Again, this problem, they started and they joined in January 1. They want a balance sheet January 1. They throw in all this extra information about partner draws and net income after the first year of operations, kind of to throw you off a little bit. So you just really want to be mindful of key facts. Again, getting the facts down. Maybe a key facts here would have been Jan 1 formulated business, Jan 1 complete balance sheet. So if you do that, then you're probably less likely to make a mistake and go ahead and add in all this extra stuff that you didn't need to add. Okay, fairly straightforward, nothing hidden to that problem. There'll be many more tutorials for you to review and really make sure that you take the time to understand, particularly the tricky part I find for everybody is this equity section. So don't be afraid of it, don't shy away from it. Make sure you go through and review this numerous times with practice so that you're really comfortable when you come into a testing situation. Alrighty, thanks very much, everybody.